You hit the right buys. Higher time frame was bullish, structure was clear, the trend was intact. And then a few aggressive bearish candles appeared, a lower time frame change of character formed, the move felt real. It felt strong, so you flipped. And the market continued bullish without you. That was not a strategy problem. That was not even a structure problem. That was a perception problem, and it is the most expensive mistake in trading because it happens exactly where institutions need it to happen. By the end of this video, you will understand why your chart has two completely different structures running simultaneously and why reacting to the wrong one is not a beginner mistake. It is a designed outcome. You will understand what institutions are actually building during those aggressive bearish moves inside a bullish trend, and you will understand why the structure creating the strongest emotional reaction is almost never the structure that matters. Stay with me because what I am about to show you explains every time the market moved exactly where you thought it would after you already exited. I am Bilal, the disciplined trader. I have been in trades where the 4-hour chart was cleanly bullish. My analysis was correct and I still exited 15 minutes before the continuation began. Not because the analysis failed, but because a lower time frame change of character felt more real than the higher time frame structure I had spent an hour building. Let's get into it. Here is what happens to almost every developing trader at some point. They study the higher time frame. They identify the trend, bullish structure, clear higher highs, higher lows. The narrative is obvious. They are aligned. Then the pullback begins, and it does not feel like a pullback. The candles start accelerating lower. The unrealized profit that was building disappears candle by candle. The bullish conviction you had 30 minutes ago begins feeling irrational. You start questioning whether you missed the entire setup, whether the higher time frame analysis was wrong, whether you missed something obvious that everyone else can. A lower time frame change of character forms, the displacement accelerate, and somewhere in that sequence, without making a conscious decision, your bias flips. You exit the long, some traders short, they commit fully to the new direction, and then price reverses. Continues bullish, pushes past the level they exited, straight toward the target they had identified. Because before the pullback destroyed their conviction, they were right about the market and they still lost. Not because their analysis failed, because their nervous system could not separate local pain from macro intention, because a few aggressive candles on a lower time frame felt more real than the higher time frame structure they had spent hours building. And in that gap between what the market was doing and what the market was making them feel, institutions operated freely. I have been in trades where the 4-hour chart was cleanly bullish. My analysis was correct and I still exited, or worse, flipped short 15 minutes before the continuation began. Not once, repeatedly, with a small account where every wrong decision was not just a loss but days of preserved capital gone. I would build the higher time frame narrative carefully, identify the structure, understand the direction, and then a lower time frame change of character would appear. Aggressive candles, strong displacement, everything my nervous system had been conditioned to read as real. And the conviction I had built over an hour would collapse in 60 seconds. That is not a technical failure, that is a nervous system failure. And it cost me more than bad analysis ever did, because I was right about the market and wrong about which structure to trust when the pressure arrived. That gap between knowing the higher time frame and holding it under pressure is what this video addresses. Here is what almost every trader believes about a structure. They believe the structure creating the strongest emotional reaction is the real one. Think about what that means partially. A few aggressive bearish candles appear, a lower time frame change of character forms, displacement accelerates, the move feels urgent, it feels certain, and without realizing it, the trader promotes that local movement into directional truth. They override their higher time frame narrative with the emotional loudness of what is happening right in front of them. Traders are not reading structure, they are reading emotional intensity, and institutions have known that about you from the beginning. This is the core contradiction that separates retail perception from operator their perception. Traders believe the most convincing move is the most meaningful move. Operators understand the most convincing move is often the most engineered move, because conviction is exactly what institutions need from you before they can execute efficiently against your position. They do not need you to be wrong about the direction. They need you to be wrong at the wrong movement. And the way they engineered that movement is through internal structure, through temporary bearishness inside bullish delivery, through aggressive displacement on lower time frames with higher time frame intention remains completely unchanged. The market did not reverse, your perception did. In a moment, I am going to show you exactly what this looked like on a chart. The complete institutional sequence: external expansion, internal bearish engineering, liquidity collection, continuation delivery, and I am going to show you the exact candle, the exact movement where most traders collapse their buys and why that movement exists by design. But first you need to understand the architecture, because once you see how these two structures relates to each other, the chart you have been reading for months begins to look completely different. Every chart you open has two structures running at the same time: external structure and internal structure. External structure is the road, the major swing highs and lows that define where the market is actually delivering higher highs and higher lows. The dominant trend is bullish, lower highs and lower lows, the market is moving lower. This is macro intention. This is where institutions are building toward. This is the structure that determines direction. Internal structure is what happens inside each leg of that road. The small structure that forms within each major swing, mini break-off structure, internal change of character, micro pullbacks, local displacement. This is where entries are refined, and this is where retail traders get destroyed. Here is the rule that changes everything about you how to read a chart. Only external structure determines trend. Internal structure is noise, unless it aligned with what the external structure is already doing. Let me make that physical. The 4-hour time frame shows a clear bullish trend. Higher highs, higher lows, external structure is intact. You drop to the 5-minute chart and you see a strong bearish change of character. Aggressive displacement lower, the move looks like a reversal. Retail sees a trend change. Retail flips short. The candle are aggressive, you can feel it. The lower time frame is screaming reversal, and every instinct you have been conditioning through scream time is firing simultaneously. This is not a failure of discipline in that movement. This is your nervous system doing exactly what it was trained to do, responding to the most emotional loud signal available. The 4-hour chart is quiet. The 5-minute chart is urgent, and urgency always wins against silence until you understand why the silence matters more. Smart money sees a pullback inside a bullish delivery campaign. Smart money waits. What retail reacted to was internal structure. What smart money observed was external structure. Same chart, same candles, completely different perception. Now here is the deeper institutional logic behind why internal bearish structure exists inside a bullish trend. Institutions cannot simply buy aggressively without consequences. Large positions require counterparties. They need sellers. They need liquidity. And the most efficient way to create sellers inside a bullish trend is to engineer temporary bearishness that triggers retail shorts entries and stop losses. So they build internal bearish structure deliberately. Inside a bullish external leg, institutions often follow this sequence. They build internal bearish structure first. Candles begin moving lower, a lower time frame change of character forms, retail sentiment shifts bearish, sellers enter, stop losses from long positions triggering. Then they sweep the internal lows. Liquidity is collected, the emotional commitment of retail traders reaches maximum. Then internal change of character forms to the upside. The bearish structure that triggered retail shorts breaks. Displacement returns to the bullish direction. Price returns to the origin of the move. The order block, the fair value gap, the imbalance left during the initial leg, and then continuation. The external bullish trend resumes. Higher highs form. The macro delivery continues exactly as the higher time frame always suggested it would. The entire internal bearish sequence exited for one purpose: to create the liquidity institutions needed to continue the move you were already aligned with before your perception collapsed. Now I want to show you this sequence on a chart, because understanding it intellectually and seeing it visually are two completely different experiences. And once you see it, once you recognize the pattern of engineered internal internal weakness inside macro delivery, you will never look at a pullback the same way again. Picture this on a chart, daily time frame, clear bullish trend, higher highs, higher lows, the macro structure is obvious. You are long, your bias is correct, your target is above. Then the pullback begins, not a gentle drift lower. The candle accelerates, each one closes lower than the last. Your profit shrinks with every candle. On the 15-minute charts, a change of character forms, clean, confirmed, textbook. The bearish displacement strengthens. The move has urgency. It has commitment. Every pattern recognition system in your brain says this is real. And this is the movement. This is where most traders lose the trade they were already winning. Because the 15-minute chart is screaming reversal. And the daily chart, the one that actually determines direction, is completely silent. Nothing changed at the level that matters. The higher time frame, higher lows is still intact. The macro delivery is still pointed upward. But the emotional loudness of the lower time frame has already overridden it. Now watch what happens next. The internal lows are swept. The final sellers are triggered. The traders who short the change of character, the trader who panicked out of longs, the traders who left 15 minutes structure override for our narrative. Their stop losses becomes the fuel. Then internal change of character forms to the upside. Price retraces back into the exact candle where the bearish displacement originated. The same candle retail traders used to confirm continuation lower becomes the launch point of bullish expansion. The imbalance left during the aggressive bearish move gets filled as price accelerate upward through it, and then continuation. The daily higher highs forms, the macro delivery completes. The traders who flipped short are now trapped in the opposite direction. The trader who exited their longs are watching the move they predicted happen without them. And the traders who understood difference between external delivery and internal engineering, they were already positioned. They watched the bearish sequence with calm recognition. Not because they were certain, because they understood what internal structure is designed to do. They were not reading emotional intensity, they were reading structure. Most traders are not reading structure, they are reading emotional intensity. And institutions have no doubt about you from the beginning. Every aggressive bearish candle inside a bullish trend is a question. The question is not, did the trend change? The question is, can you tolerate temporary contradiction long enough to see where price is actually delivering? Because the traders who answer yes to that question, who can remain perceptually stable while internal structure engineers fear around them, those traders stop being liquidity. They become the ones collecting it. The transition from reactive trader to contextual operator happens at a specific movement. It is not when you learn a new pattern. It is not when you find a better entry. It is not when your win rate improves. It is the first time you watch an aggressive bearish move form on your chart inside a bullish trend and your nervous system does not react. Not because you are forcing calm, because you understand what you are looking at. You see internal structure doing exactly what internal structure is designed to do. Engineering participation, creating liquidity, building the fuel that the external delivery campaign requires to continue. And instead of asking, did the market just reverse, you ask a completely different question. Is the external structure still intact? That single question asked from a place of structural understanding rather than emotional reaction is the difference between the trader who gets trapped and the trader who was already waiting for this movement. The chart did not change, the perception did. Go back to your last 3 losing trades. The ones flipped your buys mid-trade, the ones where you exited a winning position too early, the ones where you shorted into what turned out to be a pullback. For each one, open a higher time frame first. Ask one question. Was the external structure still intact when I changed my mind? Just that question. Nothing else. No entries, no analysis. Just, was the road still pointing in the same direction when I decided to turn around? Then mark the exact candle where your buys collapsed. Not what the pattern was, what it was designed to make you do. Do that for 3 trades. Write one sentence next to each one. The external structure was intact. The internal structure manipulated your perception, and now, for the first time, you can see exactly where it happened, exactly which candle, exactly which change of character, exactly which movement of engineered fear collapsed, the conviction that was correct from the beginning. That awareness is the beginning of the transition. not from losing to winning, from reacting to reading. Your chart has two structure. One tells you where the market is going. The other tells you a story designed to make you doubt it. The skill is not learning to read both. The skill is learning which one to trust. If this is the work you are doing, stay on this channel. I only post when there is something worth teaching.